This is a question called glove. It's a complex group question. What I've done is short-circuited it slightly by writing out some of the headings just to save a little bit of time. What it is important to do in the exam is to have in your head a structure. Remember, you've got 15 minutes of thinking time effectively at the start of the exam. So what I'd be doing in those 15 minutes, I'd be looking at the extra information in the question and cross-referencing. I'll be getting in my head the right picture of the group and things of this nature. I think it's very, very important to do things of that nature as far as the exam is concerned. So we have 3 companies in the group. Let's work out that group structure. So always determine that to begin with. So it says in note A that as far as our 3 companies are concerned, we've got the parent company called Glove. Glove has 80% of body, and body has 70% of fit. So therefore we have a direct NCI of 20% and a direct NCI of 30% in the 2 companies. But here we need to build our matrix to work out who owns what in terms of entitlement to profit. So I've got body and fit. So our direct investment, 80%, indirect, 80% times 70%, and the NCI, remember, is our balance. The NCI has 20% of body's profits and 44% of fit's profits. Get that wrong and we've got a problem. It makes it very difficult for the markers to deal with those calculations. Once we've established that, so clearly we've got a parent company and 2 subsidiaries. We're going to consolidate all 3 companies in the group. We don't have any joint ventures. We don't have any associates in this particular scenario. That means in our head we're going to use the single entity concept to deal with all 3 companies. So I'm going to start to work my way through the question line by line. Notice that I've added in a line for goodwill and I've added in a line for the non-controlling interest as well. We know that that's going to always be the case as far as a P2 exam is concerned. So we start off with PPE, and all I'm going to do is to add together glove, body and fit. But I know from experience that there's likely to be some adjustments, so I'm just going to put in an initial figure of 306. Next, we've got the investment in body. This is Glove buying shares in body, so it's a direct investment costing 60. The cost of investment is used to calculate goodwill. So here we can slot in our direct cost of 60. We then have body buying shares in fit. Now remember, we are preparing the consolidated accounts of Glove. So what we say here is, well, how much has that investment cost Glove? Well, it's cost Glove nothing directly, but Glove owns 80% of body. So you can see that indirectly it has cost Glove 80% of that cost of 30. So my indirect cost in fit, the total cost is 30, and Glove's share is 80%, so that works out as 24. Now, who has bought the other shares in fit? NCI, absolutely. So we've got an indirect cost in fit, and that indirect cost is 20%. 20% of what? It's 20% of 30. So I show that, but I show that as a negative, and this is where a number of people get a bit confused and say, why is that a negative? Let's think about what we're dealing with here. We're dealing with the non-controlling interest. The non-controlling interest is part of equity. Equity is a credit entry in our accounts. But a cost of an investment is an asset. An asset is a debit. So what have I got? I've got an asset in an equity account. Well, it's on the opposite side. So if it's on the opposite side, I have to show it as a negative because you take away assets from equity, don't you, to get a net figure. So that's our indirect cost in FIT. We've got some investments in equity instruments. So I'm going to slot those in. Just add in an extra line. Don't know why I missed that off first time round. There's no adjustments. Investments in equity instruments simply means that Glove has gone out and it's bought shares in other companies. Then we come to current assets, and I'm going to add those up. I've looked at the notes. There's no adjustments to make. There's no intragroup inventory profits. There's no intragroup balances. So I can add these three, and that gives me a grand total of 114. The examiner quite often will combine inventories, receivables, and cash and just put in a single current assets total because the examiner wants to concentrate on the principles rather than just adding up numbers. So that deals with the asset side of the scenario. Next we come to shares. It is only the shares of the parent company that appear in our consolidated statement of financial position. We then have the shares of body and fit. We go to our net assets working. So we have the net assets of both companies, and we are told in terms of shares, body has 40 million shares and fit has 20 million. We always assume, as far as P2 is concerned, that those figures don't change. They could, of course, change in the real world. Then we come to other reserves. So notice when I come to my reserves note, I've actually split the calculations. And I'm going to say in respect of the parent, we always take 100% of the parent's profits. The parent has other reserves of 30 and a retained earnings total of 135. When it comes to our subsidiaries, we go to the net assets working. I've got other reserves. Body at the SFP date is 5 and fit other reserves of 8. When it comes to retained earnings, at the SFP date, body has a figure of 25 and fit has a figure of 10. Current liabilities, add those together. Oh, sorry, non-current liabilities, add those together. I've referenced those to one of the notes, so I think that might need some further adjustment. So I've got here a figure of 50. Current liabilities, I've not referenced those. I've used my time as effectively as I can, my extra 15 minutes. I can't see any adjustments in respect of those, so add together 35 plus 7 plus 5, and that gives me a total of 47. So we've therefore dealt with all of the information shown in the statement of financial position themselves. We now come to the extra information. In Note A, it says Glove acquired 80% of Body when Body's other reserves were 4 and retained earnings were 10. The fair value of the net assets was 60 million. So this is how the examiner likes to quite often set out the information. The examiner will tell us a fair value total and means that we have to work out the fair value adjustment. If we add up these three figures, according to the financial statements, the net assets at the date of acquisition came to 54, but we are told that their fair value is 60. Therefore, we must have a fair value adjustment. And our fair value adjustment is the balancing figure. So that gives me a balancing figure of 6 million. Now let's think about what we've done. We've just increased equity by 6. The only way we can get the balance sheet to balance is if we're going to increase equity by 6, we must increase the other side of our statement of financial position by 6 as well. And what are we doing here? It says the fair value of the net assets at FIT was... the excess of the fair values is due to an increase in the value of land. Well, land is PPE. So I'm going to go up to my non-current assets. And that's my 6 million PPE adjustment, my fair value adjustment. I've increased assets, I've increased equity, my account still balance. It also says in Note A, the fair value of the net assets of FIT at that date of acquisition was 39 million. So we go to FIT, it has net assets of 39 million. And we're told that the other reserves of FIT were 8 million at acquisition and retained earnings were 5. If I add those three figures together, I get a figure of 34 million. So my fair value adjustment in respect of FIT is 5 million. Increase equity by 5. I must therefore also increase assets by 5. And we're told that that adjustment is in respect of land. So I'm going to increase land like so. Oh, sorry, retained earnings was 6 at the date of acquisition. Yes, sir, I've copied that figure wrong. So that deals with Note A. Note B, Body, which is our subsidiary company, owns several trade names. And it's marketed these as an expense to costs, and that's in line with IFRS. None of these had been acquired externally, and therefore they've not been capitalized. Again, that seems to be a valid issue. On the acquisition of Body by Glove, valuation experts valued the trade names at 5 million. Now, when you acquire a company, you acquire all of its assets, including its intangible assets. This is an intangible asset which has a value that is separate to that of goodwill. We are told that that trade name has a value of 5 million. So I'm going to say here that we have intangibles which at the date of acquisition had a value of 5 million. If I'm going to increase intangibles by 5 million in assets, I must increase my net assets in the equity section. Intangible, brand. How much is that? 5 million and 5 million. It says the valuation of the trade names is not included in the fair value of the net assets of body. The group policy is to amortize intangible assets over 10 years. Here we have to look at the dates very carefully. We acquired body on the 1st of June X5. It is now the 31st of May X7. So we have owned body for 2 years. So I'm going to amortize the brand with 2 years out of 5. So we're 2 years out of 10. Multiply that by 5 million. And I'm going to amortize the brand by 1 million, because you amortize it in the period post-acquisition. Therefore, if we go up to intangibles here, I'm going to take away the amortization of 1 million, so that takes me down to a SFP value of 4 million for my brand. That's note B. On the 1st of June X5, we introduced a defined benefit retirement plan. Now remember, I've said to you in the past that when we looked at retirement plans, when we looked at pensions, they could appear in either Section A or Section B of the exam. You cannot afford to ignore them. They're likely to be only worth, if it is in Section A, they're likely to be worth, perhaps 4 or 5 marks. It's 4 or 5 marks worth having. So what I'm going to do here is I'm going to set up a fresh working number 6. Is my pension. During the year, the loss on remeasurement was 1 million, and the gain on remeasurement on the assets was 900,000. So we've got a loss on obligations of 1 million, and we've got a gain on assets of 0.9 million. So we have a net remeasurement loss of 0.1 million. Now if that's a net loss, that's going to be credit pension liability 0.1. What do you do with remeasurement gains and losses? Take it to reserves, but which reserve? Yeah. Other comprehensive income, correct. So I'm going to debit OCI, and OCI flows through into other reserves. So think about the treatment in your statement of profit and loss, and then think how that's going to flow through into reserves. So I'm going to increase my pension liability, and that's likely to be a long-term liability. So plus 0.1, that comes from working number 6? I've forgotten myself now. Yeah. So I'm going to credit non-current liabilities, and if we go into reserves, pension remeasure 0.1 from working number 6. Note D. This is tricky. Glove issued 30,000 convertible bonds with a 3-year term repayable at par. So we're dealing with a financial instrument here. The bonds were issued at par of $1,000 per bond. Interest is payable in arrears at a nominal rate of 6%, but the bond can be converted into 300 shares in glove. So what is this? This is what we refer to as a complex a complex financial instrument. And step 1 when dealing with it, we calculate the bond element Now, I wouldn't go into this degree of narrative if I was answering an exam question, but this is for sort of tutorial purposes as much as anything else. We calculate the bond element by discounting the cash flows using the interest rate on or of a similar non-convertible bond. So if we start off with the date, when was the bond issued? It said the bonds were issued on the 1st of June X6. So they're issued at the start of the present year. What's the cash flow going to be? The first cash flow is on the 31st of May X7, which is when we're preparing our accounts. What is that cash flow going to be? We are told that we are paying interest at 6%. Yeah, 31st of May. So that cash flow works out as 1.8 million. But we're going to discount that using the rate of interest on a similar non-convertible bond. That's going to be 8%. So what I need to do here is to take 1 and divide that by 8%. So That gives me a figure of 0.93. So the present value, if I multiply that by 1800, gives me a figure of 1667. At the 31st of March X8, again, our cash flow would be 1800. Discount that for 2 years. That gives me a figure of 0.86. So that's 1543. If we take a look at X9, this is when the bonds can be bought back. So therefore the cash flow would be the capital. We always assume that all of the bonds will be bought back. So that's going to be 30 million plus the interest of 1.8 million. That gives me a figure of 0.79. 25243. Add all of those together, gives a grand total of 28454. So therefore, what is the double entry? So step 2, we do our double entry. How much cash have we received? When we issued the bonds, we received cash of 30 million. Of which we have just said 28454 will be the liability. So we credit equity with the balancing figure, and that balancing figure works out as 1546. And that figure we would take to other reserves. Okay, so it is messy. So financial instrument $1.546. But remember I said to you that dates are very important. Here I'm turning into an accounting nerd. This is the value at the 1st of June 20x6. Now, when are we preparing the accounts? We're preparing the accounts at the 31st of May 20x7. So if we try to work out the value at the 31st of May x7, let's work out what happens here. First of June x7. What have we done? $28454 in the statement of profit and loss. There's an 8% interest charge because you charge the rate of interest that would be applied to similar non-convertible bonds. So 28454 times 8% gives me a figure of 2276. That's 8% multiplied by the amount that I've borrowed. What is the cash flow? 30 million times 6%. So the cash flow is going to reduce the liability by 1,800. So our SFP liability 28454 plus 2276 less 1,800 28930 or 28.93. Let's get these figures right. So let's just read what's happened. The bonds have been included in non-current liabilities at their face value of 30 million and no bonds were converted. So what I'm going to do is I'm going to take those bonds out of my liabilities. So go up to my statement of financial position. I'm taking them out of the value of 30 and I'm going to replace them with our recalculated balance of 28.93. Okay, nasty. And if you think that was nasty, it's going to get even nastier now. Can you see that there is a difference between the cash interest that we have paid and the charge that should have been made to our statement of profit or loss? Okay, it says the interest has been paid and accounted for in the financial statements. But we've got a difference between the figure that should have been charged to the statement of profit and loss, which is 2.276, and the figure which has been charged of 1.8. So this would be debit in the statement of profit and loss and credit our liability. Well, the statement of profit and loss flows through into retained earnings, doesn't it? This date is the 31st of May, X7. We borrowed, yeah. The start of the year is X6. The end of the year is X7. This is our timeline over the year. The figures that we charge to the statement of profit and loss are the figures for the income statement or the statement of profit and loss for the year ended the 31st of May X7. So what I'm going to have to do here is to reduce my profits, interest on financial instrument, from working number 7 0.476. Okay, so that's note D. Note E, obscure point this. It was a bit mean of the examiner to test us on this. This is an asset swap. We value the asset acquired at the fair value of 6 million. We value the asset that we have lost at its fair value at the disposal date. Well, it says in exchange for the plant, the supplier received land. So what's happened is that you've given me a factory and I've given you land. And the land that I've given you has got a value of 7 million. But in the accounts, it was valued at 4. So that's a 3 million gain. So we debit PPE 3 million and credit, because we've effectively sold the land, we can realize the profits. So I can take those profits through to retained earnings. Okay, very nerdy point. Very few people would have successfully dealt with this. So don't worry about some of these more obscure points. I mean, I need to show you them for teaching purposes, but I wouldn't worry about remembering them too much. So this should be PPE. Let me just ignore that PPE figure there. So I'm adding 3 million to PPE. And I'm also going to add 3 million to retained earnings. Yep. So what have we done here? We've brought in a new asset. And effectively, yeah, sorry, I should have my PPE figure. I didn't set out my workings particularly well. So I've lost an asset in the accounts at 4. I'm going to replace it with an asset, and I'm going to show it at the value of the asset we've given up, which is 7. So I've increased the value of my assets by 3. Note F, goodwill has been tested for impairment and no impairment loss. It's already in there at the old value of 4 because we've not showed anything. So what we've got to show is the increase in value from 4 to 7. So it looks as if it's actually overvalued by 1 million, but under the accounting rules, you actually value it. Yeah. Yeah. So we've had our impairment test, and we've got no impairment loss. It's group policy to value the NCI using the proportionate method, so we don't need to know the fair value of the non-controlling interest at the acquisition date in this example. What we can therefore do is now go to the question and we can add up our figures. So the fair value of all of our net assets at the acquisition date was 65. That value is now 80. We've got an increase of 15, but I'm going to split that increase and to say that it's going to be an increase of 1 for other reserves, because other reserves have increased from 4 to 5. So if the total increase is 15 and 1 of that increase is down to other reserves, 14 of the increase, which is the balancing figure, must be in relation to retained earnings. Other reserves have increased from 4 to 5. So therefore other reserves have increased by 1. If our total increase in net assets is 15, and we're going to say 1 of that is due to other reserves, then the other 14 must be due to retained earnings. If we now turn our attention to FIT's net assets at the SFP date are 43. How much of that increase is down to other reserves? It's 0. So we can say plus 0 other reserves. And therefore, retained earnings must have increased by 4 during that period. Okay, and the examiner tends to set these questions, if we get an SFP question, using this same formatting nearly every time. So make sure you're familiar with it. Think about the logic behind what we're doing. We've got goodwill, we've got our direct cost, to which we add the NCI at acquisition. Now, the good thing about the NCI is they do not care whether we're dealing with retained earnings or other reserves. They just want to say what's the value of the net assets. So for body, the NCI have 20%. 20% of what? At the acquisition date, the net assets are 65. If we now take a look at FIT, at the acquisition date, the net assets of FIT are 39. What proportion are you going to give to the NCI? Go to your matrix, and it's 44. Less the net assets at acquisition from working number 2, and those figures are 65 and 39. Goodwill is 8 for body, 2.16 for fit, gives us a grand total of 10.16. Go up here, goodwill, 10.16 from working number 3. We have the NCI. We give the NCI their share of the subsidiary since acquisition. For body, their share is 20%. And remember, the NCI don't care about the differences between other reserves and retained earnings. So they simply see an increase of 15 between our two key dates. 20% of 15 is 3. We had the NCI at acquisition as well, of course, which is 13 and 17.16. Those have come from working number 3. And for fit, %, the change since acquisition is 4. 44% of 4 is 1.76. So you end up with an NCI total of 10 and 18.92, which is a grand total of 28.92. That's working number 4. What is outstanding is group reserves. We say for the group, share of subsidiary. For body, it is 80%. But I need to split those figures. Other reserves increased by 1, and retained earnings increased by 14. So 80% of 1 is 0.8. 80% of 14 works out as 12.6. And for fit, the group share is 56%. 56% of what? Other reserves have increased by 0. So 56% of 0 is 0. Retained earnings have increased by 4. 56% of 4 is 2.24. $32.246 $150.964. %, of, oh no, sorry, it's not. It's 11.2. Sorry, 80% of 14 should give us the figure of 11.2. We therefore have totals to take to the equity section of our statement of financial position. Other reserves, 32.246 from working number 5. The retained earnings, 150.964 from working number 5. If we put through our adjustments for non-current liabilities, that adds up to 49.03. So I've got 150 plus 32.246 plus 150.964 plus 28.92 plus 49.03 plus 47. That gives me an overall total 458.16. Our non-current assets, 306 plus 6 plus 5 plus 3. Non-current assets is 320 plus 10.16 plus 4 plus 10 plus 114. And that adds up to 458.16. Now it could be that I'm just having a lucky day. Everybody has a lucky day once in a while. Could be that today I should be buying a lottery ticket.